when there is a breakdown of trust in the dollar as a gold derivative,
Hmm.
then the only way to divide gold is with silver because
Right.
dollars are no longer trusted. Everything's getting messed up and banks are falling and this and that and everything's falling apart and electricity is starting to go down. Whatever it is, that all of a sudden the silver price is going to not just climb, it's going to explode in terms of purchasing power, and the dollar price isn't even going to matter at all.
It's up to about $5,100 for gold. As silver, I'd have to look at it. Silver would be, it's roughly about a 60% move. So we could just quickly grab from where we are right here. So, I mean, we're talking way up, 80 and change here
Right.
to the upside. So this is a pretty big move. I mean, I talked about $82 silver a couple of years ago saying, if things were to blow off, that's kind of where it could go.
A profound shift is forming beneath the global monetary system as trust in the dollar's role as a gold derivative continues to erode. When confidence breaks, the adjustment does not unfold slowly. Markets jump directly into new pricing realities. In such moments, gold reclaims its monetary dominance, while silver accelerates even faster, responding instantly to systemic stress and breakdowns in credit, liquidity, and electricity-dependent infrastructure. These shifts create explosive moves in purchasing power, not gradual steps. Rafi Farber, a longtime monetary analyst, and Chris Vermeulen, a veteran market technician, explain that when paper claims lose credibility, gold rushes back into the financial system, but it is silver that becomes the practical unit for division and exchange. Their assessment suggests a rapid return to the historic 15-to-1 monetary ratio, a level that has repeatedly emerged during past systemic shocks. Based on the current structure, gold's move toward the $5,100 region becomes a natural recalibration point. At the same time, silver, already positioned for a powerful technical surge, could sprint into the $80 to $82 zone in the early stage of a monetary reset. They warn that the next crisis will not resemble the slow regional failures of 2023. Once liquidity fractures, QE restarts, and banks face cascading losses, the transition into hard assets could unfold within hours or days. As debt is rapidly devalued to near zero, both metals become the primary refuge, with silver often taking the lead in real-world purchasing power. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I don't think silver is going to evolve. I think it's going to just appear suddenly as the preferred money over gold in the initial explosion post-endgame. If you picture the analogy, let's say, chas v'shalom, God forbid, a nuclear bomb falls on a major city, and then all the surrounding areas have nuclear fallout and all communications are down, or there's a Carrington event, solar storm, and all communications just suddenly go down. Then the evolution is not gradual, it's sudden. Sort of like what Ernest Hemingway said about bankruptcy, right? It happens gradually and then suddenly. So silver will appear suddenly. We will suddenly be at the natural monetary ratio of 15-to-1. I don't know why the natural monetary ratio is 15-to-1. All I can tell you is that historically it's usually around there when silver and gold are both freely exchangeable for other things and government isn't involved. That's just what it is. So we've seen that ratio reappear 3 times in the 20th century. In 1919, post the World War I inflation, after that deflation of all that money because we were still on a more of a hard gold standard at that time. So the sudden deflation put all the purchasing power in silver. It's not that necessarily that the dollar price of silver went up that much. It's just that relative to gold, silver went way up. Right?
Mm-hmm.
Who cares about the dollar? It also happened in 1960 and in 1968 with the fall of the London gold bull suddenly. And then things were okay for a few years. And then all of a sudden, from like 1979 to 1980, in a space of about 6 months, all of a sudden, silver went down to 15-to-1 again. Why is that? The simple answer is that the dollar is a gold derivative. It used to be a silver derivative, but from 1873 to 1971, it was exclusively a gold derivative. And now it's still a gold derivative, but it's a gold derivative with a whole bunch of inflated crap on top of it. Right? When people say that we went off the gold standard in 1971 and gold no longer represents a dollar, don't you know that Nixon closed the gold window, blah, 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 blah. Yeah, I think I know, like, I've been in this space for like long enough to know that, yeah, he did close the gold window, but that doesn't mean that dollar is not a gold derivative. It just means that the dollar is a gold derivative at a fake gold price plus a whole bunch of debt that plugs in that fakeness. And when the debt itself is realized to be fake because it can't be paid back, then the fakeness goes out of the debt and all of that stuff goes back into the real gold price. But when there is a breakdown of trust in the dollar as a gold derivative, then the only way to divide gold is with silver because
Right.
dollars are no longer trusted. So there's just going to be a sudden invasion of gold into the monetary system, back into the monetary system. It could happen within hours, within days, within weeks. I don't see any more than that. All of a sudden, like when you see that everything's getting messed up and banks are falling and this and that and everything's falling apart and electricity is starting to go down, whatever it is, that all of a sudden the silver price is going to not just climb, it's going to explode in terms of purchasing power, and the dollar price isn't even going to matter at all. I don't think about the central bank gold purchases because I don't see them happening. I don't know what anyone's talking about.
Right.
If someone were to show me some data, I would say, okay, all I see is that people are quoting other people saying that there's a whole bunch of central bank gold purchases, but I don't see any data that central banks are actually purchasing gold. So if I can talk about it theoretically,
Right.
what it means, if central banks are purchasing gold, which I don't think they're doing, please share in the comments below a link to the cumulative stash of gold, and maybe it's gone up a little bit, but since 1950, it hasn't gone anywhere. So what is anybody talking about? Theoretically, if central banks are buying a whole bunch of gold, yes, that would affect the gold price in dollar terms because it would be a source of demand, but that won't save any currency. If central bank A is buying gold, it doesn't save its currency. It has nothing. It doesn't have any impact on its currency or on the value of its currency because everyone who uses that, whatever currency that is, knows that the central bank is only playing a trading game. Right?
Right.
The most obvious, the only way gold can save the value of a currency is if the central bank says, you know what, we bought a bunch of gold, and now we're gonna stop printing. We're gonna let the banks collapse, and anyone who has any unit of our liability can now exchange it for pro rata for this amount of gold, however they divide it.
Right.
And they have to divide. So that would save a currency, but central banks don't buy gold to solidify their currencies. They buy gold as fuel to sell when their currencies are dying, and that will only kill them faster. The Fed restarting QE, and then the Fed, and then some kind of banking horror show like 2023, except bigger.
Right.
Remember, the 2023 regional banking crisis ripened or developed in a few hours, right? It was like
Wow.
one day, it was one day, nobody was suspecting anything. And then the next hour, Silicon Valley Bank stopped existing.
Yeah.
That,
Yeah. It's pretty,
that was
crazy.
it. That was it. So something like that. The next banking crisis should be it because it's going to spread everywhere, and we're seeing cracks in these little bankruptcies in private credit. But the Fed moving, very short-term interest rates ticking up, QE restarting, banking crisis cutting to zero, and that's what's going to happen, and probably somewhere in that order, and then it should be over. I think it's nearly a certainty. It's not a logical certainty because theoretically, every central bank could say we're going to allow our banking systems to collapse, and then see what happens. But none of them are going to do that, so they're just going to be printing money, and then it'll be hyperinflation.
Right.
So the answer is, what do I see about debt levels in the next 10 years? Debt levels will go to near zero because the debt will be devalued to zero, and so the value of devalued debt is nothing, and there will be no debt because all the debt will be gone. Fiat
Yeah.
is something because every central bank manages the fiat supply, and what is What is the central bank that manages the fiat? The central bank, the fiat currency, the unit of the dollar or the euro is a fraction of everything that central bank owns.
Right,
So
right, right.
it represents
There's
everything on the
something
balance
there.
sheet. There's something there. It's something. Most of it is nothing. The debt is nothing because it's going to fall to nothing. But there's still something there. Even if there's no gold on the balance sheet, there is at the Fed. Let's assume it exists. But if it doesn't exist, if there's no gold, let's say that there's no gold on the balance sheet of the Bank of Canada, fine. But the Bank of Canada exists. It's a building, right? They own buildings. There's something there. So it's still something because everything is connected by debt. Everything affects everything because everybody buys everything with debt, including the Federal Reserve, which is the currency. If somebody buys Bitcoin with debt and then it falls and then he has to redeem the debt and then buy back it's a short position on the debt. And then he's in a margin call and that affects the next guy buying the line and everything just falls at the same time. That's what it is.
Gold has been signaling a deep strain beneath the global financial system for years, even as equities continued to grind higher. Both markets have rallied in tandem, masking the underlying weakness that is now becoming increasingly visible. Equity momentum has begun to fracture, exhibiting early signs of fatigue similar to those seen before major downturns. Precious metals, meanwhile, continue holding firm, behaving as if capital is preparing to rotate out of risk assets and into safety. This alignment mirrors the conditions that preceded the sharp divergence in 2007 and 2008, when stocks weakened and hard assets surged as investors sought stability. Gold remains resilient despite market noise, and silver's recent volatility looks more like consolidation than reversal. Both metals are responding to the growing sense that something in the global system is tightening. Declining confidence in financial reporting, strained liquidity, inconsistent data, and an environment clouded by uncertainty. With economic visibility becoming clear as mud, as many traders describe it, the need for tangible assets becomes stronger. The financial landscape is nearing an inflection point where the traditional risk cycle gives way to defensive positioning across markets. Now, let's get back to the interview.
Well, gold has been telling us that something is wrong in the economy and the global system for a long time, for a couple of years. Stocks and gold have been rallying together. And I think we're very close to the stock market starting a bigger pullback, potentially 10, 20% here. And we could see precious metal space rally up, kind of like what we saw in 2007, 2008. I think gold and silver have got a very nice opportunity to the upside. The stock market is on the cusp of a real wake-up call for individuals. And the big question is when the market does roll over, do you have a game plan to not only profit or avoid the crash, but to profit from it as well in equities? Because I think it will be pretty dramatic once the music does come to an end at some point. And if we kind of look back and compare the 2007, which is the left side, the yellow line is the price of gold, which has been chopping around near the all-time highs in 2007 as the stock market started to sell off. Well, we're starting to see the same thing. We've got gold chopping around right now on the right-hand side. This is today, like where we are now, the weekly chart of the S&P 500. The equities are starting to struggle. And I believe we could see equities have a fairly decent pullback. And if we go back and look at 2007, you'll see the stock market ended up dropping about 20% and gold shot up about 30%. Silver shot up around 60%. Platinum, palladium also up about 60%. So there's some pretty good potential if the stock market does start to sell off, Danny, we're going to see that, I think, that money flowing out of stocks, and money's always looking for return on investment. So it is going to go to whatever is working. And of course, I think we're in this sweet spot that gold, silver, and precious metals complex as a whole is going to really absorb and suck up all of that capital and send it higher. So we are very close. So you said runway. I think the stock market is potentially putting in a top here, or it only has a month or so left. I do think come January, I think things could get really ugly for equities. I do think it'll continue to be strong for precious metals for maybe a month or so, but there's not much runway. I feel like we're right on the cusp of the stock market making an all-time or a major market top before we start a recession or some bad news hits. And I think gold also has the same. It's a month or two away from topping, but stock market, not much upside. The precious metal space, I think, has quite a bit of upside. It'll take us up to about for gold, it'll bring us up to about $5,100 for gold. As silver, I'd have to look at it. Silver would be, it's roughly about a 60% move. So we could just quickly grab from where we are right here. So, I mean, we're talking way up 80 and change here to the upside. So this is a pretty big move. I mean, I talked about $82 silver a couple of years ago, saying, you know, if things were to blow off, that's kind of where it could go. And that's potentially showing where it could go if this similar type of situation unfolds. Now, you mentioned earlier, maybe there's a double top in metals here. We saw silver come up and get rejected a little bit. I think in the grand scheme of things, this is just a hiccup. And I think we're still going to see a very big push higher. I think this is a consolidation. I think we're going to see silver ramp itself higher. Same with gold going forward. But again, you have to have a game plan. If silver was to start to break down and break this low around, $45, you might not want to be holding it because it could unwind in a pretty big way. Silver has had a strong parabolic move to the upside, which you can really see when you drop down to the monthly chart, which you and I looked at last time we were talking. We can go way back even further. When things go straight up, they like to come straight back down. So that's what concerns me. But there's potential here, obviously, for silver to have a much bigger spike, because I do believe we're in the best scenario for precious metals to have a move than we've ever seen before. Now, every year the case for that gets stronger and stronger, but this time around it feels, central banks accumulating, and there's just a lot more power behind this potential move. So I think the precious metals space is going to be pretty exciting. It's just, you need to be ready, because when it does reverse, I think we could see a fairly strong pullback we could see 35% pullback in gold. We could see potentially a 50-60% pullback in silver when the markets do potentially run out of steam, when these little rocket ships going straight up eventually turn around and start coming back down. Now, in the precious metal space, I think that's why we're seeing metals do so well, and gold bugs are excited, because the perfect storm is brewing for the financial system, the banking system. I think now the banks more so are, I don't know if they can go bankrupt. I was reading something the other day. I don't go too deep into it. I just don't trust them. I just don't trust the financial system, period. I just trade in and out. I like physical metals. You just never know how all those details, they change the calculations for the economic data. So like, if we don't even know when the new number comes out with the changes, like, is it better or worse than before? Everything's just murky, right? It's clear. Everything's as clear as mud, and we're all just feeling our way through it. And eventually something's going to break. And so we have to have a game plan that, hey, if something breaks, you better know what to do, when to sell, what to buy, where to move your money for safety. As we've seen the dollar fizzle down, it's carved out what looks to be a bottom. It's now, on the verge of actually having a really nice real breakout here. It's got a series of bull flags. I think we could see this kind of ratchet its way up. And I could see the dollar index going back up to like 110, 116, 121, like huge moves that we haven't seen in a very, very long time. If that happens, that means probably the stock market and the economy is kind of falling apart. Eventually, once the dollar does start to rip higher, it's going to put pressure on commodities like gold and silver. They'll probably pull back with a strong dollar. So this is definitely a warning sign. I mean, this is, if we go back and compare 2000 and 2008, if we actually go and look at what happened, if we look at the dollar back in that time frame, you look in 2008, the green line, the dollar was out of favor. Everybody was thinking currencies were going to collapse. The dollar collapsed. If we look at the right-hand side of where we're at now, we look at the dollar, it's very similar in terms of, let's show here. The dollar's, it's gone all the way down to the right. It's under, everybody hates it. It's low in value. And eventually, if the dollar does start to scream higher, we're going to see stocks in gold fall. And if we go back here, if you look at the stock market in the background in 2007, it fell like 55%. Well, eventually the dollar put in the bottom and it rallied really dramatically. And the big rally in the dollar put some downward pressure on gold. And I feel like we're going to see something similar to that. I think the dollar could still struggle and bottom here for a while. I think gold could shoot higher, but eventually I think you're right. I think the dollar is going to come to life here and put in a pretty big rally and catch a lot of people off guard. I don't know. So many people hate the dollar. It's like probably the most hated currency, I think. Everybody says it's going to crumble, but every time they think that, there's usually a sharp turning point price and it goes the opposite direction. think we had to sum it all up. I'd be like, I like precious metals still. I think there's one more big push that could last a couple of months. I think we're very close, though, to a significant high in precious metals where they might start to pull back because the economy is probably going to have a turning point. The stock market will be collapsing. So I like metals. I think the stock indices themselves, I think they're losing their uptrend here. And I think we're about to see some bigger selling. And it's going to go, I think it could buck the trend of seasonality. Naturally, we see the market go higher, but based on the momentum and what's unfolding, I think we're actually setting up for the stock market to have a pullback into the end of the year, which will be a pretty sour way to end the year, although markets are up pretty dramatically. So it'll still probably be a positive close on the year, but I think be very cautious with equities at this point.
The strain building beneath today's financial system is becoming harder to ignore. Confidence in the dollar, the banking sector, and even basic market signals is eroding at the margins, revealing a deeper fragility that is now driving capital toward tangible assets. The behavior of precious metals reflects this shift. Gold continues to serve as the market's early warning instrument, holding firm even as equities show signs of fatigue. Silver's movements, rapid surges, sharp pauses, and renewed strength suggest accumulating pressure beneath the surface, the kind that often precedes significant structural revaluations. With investors increasingly aware of systemic vulnerabilities, the preference for tangible assets over financial claims is growing stronger. Across global markets, liquidity fractures, data revisions, and sudden stresses in credit pockets highlight how interconnected the system has become. Precious metals have historically thrived in these moments because they sit outside the debt-based financial system. That dynamic appears to be resurfacing again. Gold signals resilience, silver shows the capacity for accelerated repricing, and both reflect the same message. The margin for error is shrinking as the system approaches a more volatile phase. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.